Okay, folks, we'll get going again. So between now and lunch, we have 4 sessions. It's a bit of a long slog, I'm afraid. We have break for lunch at 1:20. The next, first of the 4 is another keynote address titled "The Changing Dynamics of ESG Fund Performance and How IR and ESG Folks Can Assist in Positioning the company, your company, to best manage these changing dynamics." To talk to us about this important topic, I'd like to welcome David Macri, who's Chairman of the Advisory Board of MarketMeter, but also former Chief Investment Officer for Australian Ethical Investors, who will be known to many of you, I'm sure. Thanks very much, Dave. Over to you.
Thanks, Ian, and good morning, everyone. It's nice to be here. So like Ian said, I'll be talking about the changing dynamics of ESG fund performance. Look, I'll probably start off with saying that there's a lot of confusion by what is meant by ESG. And a lot of the times people are actually referring to any or all of the different types of responsible investing. The Responsible Investment Association of Australasia, so RIA for short, has defined the different types of RI, responsible investing, and this table can be found on their website. It asserts that all the different types of responsible investing consider and manage ESG risks, but that ESG integration is just one step along from traditional investment, but is now extremely pervasive, and I would argue that ESG integration is now considered to be the bare minimum standard for institutional investors. Whereas impact investing, which is on the other side of the spectrum, we call it the RIA spectrum, is just one step before pure philanthropy. And although it's growing in popularity, genuine impact investing is still quite niche. But although all the strategies manage ESG risks to some extent, these different types of approaches are going to yield very different performances. So I think it's wrong to group them all as ESG funds and to talk generally about them. And that table can be found on their website. It's quite handy for people to point to when they're talking about a specific RI strategy. So ESG integration merely indicates that ESG factors are considered in the investment process. Performance of an ESG fund will therefore depend on the underlying process and what factors the fund is exposed to, such as value, growth, small caps, etc. Whereas funds that screen will obviously be impacted by what investments they exclude, and therefore the extent of the screening process has a large impact on performance. Heavy screeners who, for example, exclude fossil fuels, mining, high-emitting industries will obviously underperform in the environment where these industries are doing well. And of course, we have seen this eventuate through 2022, which has led to the underperformance of heavily screened funds. However, because these funds are excluding whole industries, they must be overweight others, which generally tend to be healthcare, technology, financials, and renewable energy. So performance of these funds will also depend on how these sectors perform. But even then, it's still hard to generalise. Performance of screened funds will heavily depend on how each investment manager constructs their portfolio and how large the investable universe is, how concentrated their portfolios are, how good their research process is, and of course the people managing the process and portfolio. The third one there is the themed funds, and the number of themed funds coming to market has exploded, trying to meet the investor demand, and it's happening on a global scale. These funds will seek out opportunities in a particular theme, and the most common being climate and decarbonisation. And I won't spend too much time on impact funds, except to say that they will be the most constrained and the most likely to forego performance for the prospect of positive social or environmental impact. Now, according to the latest RIA benchmark report, which was published last year and is up to the end of 2021, $1.5 trillion was being managed in Australia responsibly. and that represented 43% of the total Australian market. And despite the recent underperformance of screened funds, money will continue to flow to RI strategies. And just on the underperformance of screened funds, they weren't the only funds to underperform. The factors responsible for this aren't unique to them. Many conventional funds with exposures to growth, tech or small caps also underperformed. The chart on the right shows that ESG integration remains the largest type of responsible investment strategy. Investment managers and super funds incorporating ESG risks into the investment process will continue to grow because, like I already said, ESG integration is now considered to be the minimum standard for institutional investors. But the largest dollar increase during the 2021 calendar year was to funds incorporating corporate engagement and shareholder action. It grew by $255 billion, up 54% over the previous year. The implications for you and your teams are that you will continue to field more ESG questions than ever before, engagement with investors will accelerate, and more than likely, shareholder advocacy campaigns will increase. Regarding themed funds, according to RIA, assets under management more than doubled during 2021. And given the whole world is attempting to galvanise governments, corporates and investors into making decisions that will contribute positively to solving the climate crisis, I can foresee a high number of products coming to market across all regions, all of them looking to allocate capital to climate-friendly companies. So the climate thematic subset will grow quickly over the coming years. Companies that will benefit from this wave of capital are those that have already been articulating a coherent climate strategy, as well as those that demonstrated a genuine commitment to addressing climate risk. Obviously, sectors and industries will have different risk profiles, but in time, all companies will need a strategy because it won't be enough to say the climate risk doesn't affect us because we're a healthcare company or we are an IT company. These thematic funds will simply ignore them and won't buy their shares. So what I think is the key takeaway for corporates is that non-financial considerations will have a bigger influence and impact on your company's prospective cost of capital due to the sheer weight of capital being directed by RI funds, and also due to the narrowing focus of these funds. It will therefore be important for you to assess how your company is considered by all types of responsible investment funds. So in my previous role as the CIO of Australian Ethical, we were exposed to a number of ESG data providers who conducted their own research. And I understand many of them required input from corporate sustainability and IR teams for accuracy purposes. Institutional investors, when it comes to ESG and sustainability, are all really trying to form a view, or generally speaking, score a company on climate risk management, culture and conduct, the effectiveness of the board, its REM policy, its social licence to operate, and supply chain risk management. The information that listed companies provide in their sustainability reports certainly helps us form those views, but we'll also look to some other sources, the most popular being Sustainalytics and MSCI research. A lot of people are also using alternative data sets, maybe going to Glassdoor to read reviews on the culture of the place, and I think alternative data sets will just continue to grow. This graphic is actually pulled from MarketMeter's corporate performance dashboard, and the platform itself distills all the various ESG data sources used by institutional investors into a single score for each ESG category for every company in the ASX 300 by going directly to the source, being the equities analysts and portfolio managers. It provides an unbridled view of the investment industry's perception of your company's ESG performance and where it sits within each of the ESG categories listed, as well as how it has been tracking over time. So by identifying the areas where you may not be perceived highly, you'll be able to focus on how to improve your scores, which will in turn improve your chances of getting on investment screens and be considered for the looming RI wave of capital. And you heard previously how fund managers and super funds are also looking at the rate of change as a potential to generate some alpha. The data can also be used by institutional investors to compare internal ESG research with peers, while super funds can use it to measure how their investment managers are faring. And increasingly, everybody will be attempting to claim impact from their corporate engagement and shareholder advocacy strategies. And regarding the big increase in the use of corporate engagement and shareholder advocacy strategies, the effectiveness of an investor's corporate engagement strategy could be measured by the data MarketMeter provides to super funds. ESG teams at super funds are potentially using the sentiment data to assess whether their engagement and advocacy campaigns are making an impact by looking at a particular ESG category time series. This chart plots a company's climate risk management score over time. The half-yearly MarketMeter data gives super funds a regular and more frequent assessment of how the investment community perceives a company's climate risk strategy, as an example. With an improving sentiment score suggesting the company has made positive changes to its climate strategy, which is resonating with the market. In this case, the score has been falling, so indicating that perhaps the campaigns have fallen on deaf ears. Without this data, super funds and investors would not be able to measure the impact of their engagement until the often long-dated target date. Now, I think this may be valuable to you to help you understand which measures are trending in either direction, which may preempt the next corporate engagement and shareholder advocacy campaign. So in conclusion, and some of the messages I'd like to leave you with today, performance of different responsible investment strategies will vary. Demand for all types of RI strategies is still growing. Supply of funds is accelerating, particularly for corporate engagement and shareholder advocacy and sustainability-themed funds. The sheer weight of global responsible investment capital will impact your cost of capital. It's critical for IR and sustainability teams to understand market perceptions of company ESG and sustainability measures to improve the chances of being considered investable by RI funds. And lastly, just be aware of the underlying ESG sentiment trend to preempt the next corporate engagement and shareholder advocacy campaign. And so with that, I think we've got time for some questions.
Hi there. I wonder if you could explain where the corporate engagement and shareholder advocacy approach, is that across all of the different types that you had on the second? Yeah.
No, so there are
Strategy.
some specific funds that are designed as that is the only responsible investment strategy it does.
Right.
And so it could potentially invest broadly across the whole market, but really target the companies it feels they can influence to do a better job, I guess. But many of the other RI strategies will obviously also engage.
Include that
yeah.
activity. Right, so it's a very specific type of
But there is a
fund.
very specific type of fund, yeah.
Right, thank you.
Thanks. Paul Murphy's my name from Georgeson. I'm just curious about the attribution issue in that effectiveness of engagement. Is that purporting? Well, is it showing share price movement? Is it other measures that a company might have taken, like to improve its board structure or something like that? So what are the metrics that go into that?
So the chart is overlaid on share price. I'm not claiming that there's any correlation between the two. What is the red line is just tracking what the score for that climate change, climate risk management is over time, and what the market's perception of that company's strategy in terms of climate risk management.
Okay, so it's the idea that that becomes a metric that the investor can use to sort of gauge the success of its
Yeah.
engagement.
So, I mean, what I'm trying to point out is that a lot of people are going to be doing corporate engagement and shareholder advocacy. They're going to want to claim some impact on that effort. This is one way that they could have a look and point to an increasing score, or if they see a negative score, then they may want to up that engagement activity.
Yep. Thanks.
We'd like to leave it there. Thank you very much,
All right.
David.
Thank you,
Please
Ian.
take over the-
Thank you.